Welcome to Module 26. We're going to begin Chapter 14 in this module, and we're going to talk about budgeting. Budgeting for a company in general in the first part of this chapter. Then in Module 27, we're going to take a budget and apply it to a particular unit of products. We're going to do specialized budgeting in the second half of this chapter. So let's talk a little bit about what budgeting is. Budgeting is just planning. It's a financial plan. You can also budget time, as many of you do. But what we're looking at here is a financial budget. A financial budget is in dollars, and it forces managers to plan ahead. It also can be used as a benchmark. If you plan to do this, how did you measure up to that? If you plan to make and sell 4,000 units, how did you do this year? So it's a good way to focus your activities and then see how well your activities are going compared to what you wanted to do. In the budgeting process of a company, everything starts with a sales budget. That's the first piece in any budgeting process, a sales or revenue budget. The next step then, once you have a sales or revenue budget, you'll have a production or a purchases budget. Once you have that, then you can do your operating expense budget, your income statement, cash, and balance sheet budgets. There is a process to the budgeting cycle. You have to start with the sales budget so that you'll know how many units you're going to have to produce based on your sales. Based on how many units you're producing, you can then forecast your operating expenses, come up with an income statement, a cash flow statement, and a balance sheet. So there's a system to it. You have to start with the sales budget. The sales forecast tells you how many units you're going to sell. Typically, this is done by going out and looking at the projections by your salespeople that are out in the field that know their customers and can give you a pretty good idea of how many units they're each going to sell. You then compile all of that into one number, and that becomes your sales budget. Once you have come up with your sales budget, then you look at, okay, if we're going to sell that many units, how many units do we have to make? You may want to make a few more than you're going to sell so that you'll have some inventory on hand, something what we call safety stock, so that if you sell more than you expect, you'll have some units there and you won't stock out of your product. But lots of times what you're looking at here is if we sell 4,000 units, we're going to have to make at least 4,000 units. If you know how many units you're going to have to make, then you know what kind of costs you're going to have, how many raw materials you have to purchase, how much direct labor you'll have to hire, and then you'll have to look at your overhead budget to look and see what your overhead costs will be. So once you have a production budget, you can go through and get all the pieces for the product cost. Once you have that, then you can go through and do a cost of goods sold budget. When you look at, okay, here's what we're going to sell, here's what we're going to have in revenue, the difference is going to be our gross profit. How did we get that cost of goods sold? Well, it consisted of materials, labor, and overhead. So we can come up with these numbers based, again, on the sales budget. Once we have a cost of goods sold budget, think about your income statement. Sales minus cost of goods sold gives you gross profit. From that, you take your operating expenses, such things as your sales commissions, your depreciation expense, your salaries for non-production people. All of those things are your operating expenses. You can budget those out, estimate those items as well. Once you have those items, then you can complete your income statement. Sales minus cost of goods sold, minus operating expenses, minus interest, minus taxes gives you net income. Once you have an income statement budget, you can look at a balance sheet budget because now you know what your income is. You can forecast then your owner's equity part of your balance sheet. You can also do your asset side by looking at your cash, your inventories. You can also look at your liabilities to see if there are any amounts of money that you have to borrow to make it work. So you can come up with a budgeted balance sheet. Then finally, probably the key for most young companies is what's called a cash budget. In a cash budget, what you're looking at, okay, is where is our cash coming from? How much cash are we going to have coming in? What's our cash going to have to be paying out for? What are our costs? Are we going to have enough money to pay our bills? Looking at cash coming in and the cash we have to pay out, are we going to have enough to pay our bills? If not, we need to arrange short-term financing. If we have too much coming in over and above our expenses, we have to look at investment opportunities. So a cash budget is an integral part, especially for young startup companies who may be operating a very narrow margin. So they have to keep their cash pretty much in line and see where they're going to be. Now, a budget can be either done for a year or a month. Typically, companies do it once a year for the coming year. Perhaps they'll start, if it's January year, they'll start, say, in September or October, budgeting for the next year. A lot of firms use what we call a rolling budget, in which they constantly are budgeting for the next year, each time adding a month to the year, and keep updating their numbers for the whole year. This is much more effective, but it's also much more time consuming. A lot of companies don't have the time to invest in that. At the university, we do a one-time-a-year budget. We usually start in March for a June year. So we are budgeting once a year for a whole year, 12 months a year, starting 3 months after the budget process. So that's budgeting in general. Now think about it. You have to start with a sales or revenue budget, and you work down through all the pieces until you end up with a cash budget. Let's do a little bit of practice with that, and let's use one of the exercises in our textbook. Let's look at exercise 2, which is in the middle of page 518 of your textbook. It says that we have a company that's forecasting sales of 62,000 units of product for September. To make 1 unit of product, it takes 5 pounds of raw material. Actual beginning and desired ending inventories of raw material and finished goods are as follows. Calculate the number of units of product to be produced in September. Okay? Think about your cost of goods sold formula. You need your beginning inventory and finished goods, which they give you as being 5,900 in units. You don't know how many you're going to have to produce. You don't know what's available, but you do know that your ending inventory is given at 8,300 units, and you know that you're going to sell 62,000 units. Working backwards then, if you know that you're going to sell 62,000 and your ending inventory has to be 8,300, then you're going to have available for yourselves 70,300. Of those 70,300, you already have 5,900 units. So what you have to do then is produce 64,400 units. So that's how you calculate the number of units you want to produce. Now the next step says, okay, now calculate the amount of raw materials you're going to have to buy. Again, you use the same format that we did on the cost of goods sold statement. You take your beginning inventory of raw materials, which is given at 74,700. You know you're going to have to purchase some, and that together will be what's available. You're given that your ending raw materials will be 68,200, and you can compute the number that you're going to use because you know it takes 5 units of raw materials for each product. You're making 64,400 products, which you just computed in the previous slide. So you're going to be using 322,000 pounds. Working backwards, your 322 plus your ending inventory of 68,200 means that you have to have available 390,200 pounds. Well, that amount that you have to have available, you've already got 74,700, so that means you only have to purchase 315,500 pounds of raw materials. So that's just looking at how the budget process works for raw materials. Problem 4 continues in that same vein. The solutions are in your handout, but I wanted to just give you an idea. It's the same problem as problem 2. It's a little bit trickier because they want you to do it for 3 months, July, August, and September. So you have to finish July before you can do August. You have to finish August before you can do September. They want you to do the same thing about calculating the number of goods and the number of production pieces you have to have. It's the same type of problem, a little bit more sophisticated, but the same idea as problem 2. So let's, instead of doing the same problem again, let's look at a different problem, which is problem 5, the bottom of page 519, a cash receipts budget. Now, as we said earlier, cash is an important piece for most companies. So they're very concerned about how much money they're going to have coming in and how much money they're going to have going out. So let's look at this problem. It says Fox River Center sales are made on account. The firm's collection experience has been that 30% of a month's sales are collected in the month they make the sale, 50% of the month following the sale, and 18% the second month after the sale. Now if you add that up, you'll notice that's only 98%, which means they're not going to collect 2%. The sales forecast for May through August are, and they give you in that purple box there, the forecasted sales. Remember, that's the starting point for the budgeting process. They want you to calculate cash collections that would be included for July and August. Well, let's look at July first. In July, we're going to collect 30% of July's sales. July's sales are $300,000. We're going to collect 30% of that, so that'd be $90,000. We're also going to collect 50% of the month before. The month before July was June, and it was $280,000 worth of sales, which we get half of, so that'd be $140,000. And then we get 18% of 2 months previous, which would be the May sales, so we get 18% of $240,000 of May sales, so that's $43,200. That total will be the amount of cash that we're going to collect from our sales, covering 3 different months that we're going to collect, but all in July. So we'd have $273,200 that we're going to collect in cash in July. In August, we do the same thing, except in August we start with 30% of $350,000, work backwards, 50% of $300,000, and 18% of $280,000. So we have a little bit better collections in August. We'll have $305,400 collected in August. As a final wrap-up for this part of the chapter, let's look at the cash budget in problem 13. What you have in problem 13, about 2/3 of the way down page 522, is a company called QB Sportswear that's a customer imprinter of sportswear. And again, they want you to do some cash budgets. So let's read the information. They give you the fact that merchandise purchases and operating expenses are paid 75% in the month during the purchase and 25% in the following month. They then give you sales, cost of goods sold, all the way down through operating expenses that are forecasted for September through December. They tell you cash on hand at the end of August is $40,000. Collections of August accounts receivable should be $20,000 in September and $15,000 in October. Payments of August accounts payable and accrued expenses are estimated to be $24,000. They want you to do a cash budget. In a cash budget, what you're going to look at is, here's what we started with in cash, here's the cash we collected, here's the cash we're going to pay out. Okay, so what we're going to start with is the cash we know we have, which they give us as $40,000. Next, we have to look at how much cash we're going to collect. Well, they tell us that. They tell us we're going to collect $20,000 of our accounts receivable in September. So that means we'll have $60,000 available. So what we have to look at next then is, what are we going to pay out? Well, they tell us our accounts payable is going to be $24,000. So we're given the $24,000. We don't know how much of our purchases, except that we can look up under September purchases in the income statement there, and it tells us total purchases are $37,800. And the purple box on the previous page, 522, tells us we pay 75% of those in that month. So we take 75% of $37,800 and we get $28,350. And then we do the same thing with our operating expenses. In the income statement, our operating expenses are listed at $10,500. We're going to pay 75% of them in the month in which we incur them, which is September. So that would be $7,875 of operating expenses. So what we're going to find out by looking at this cash budget is that we're going to have $225 more in expenses than we're going to have cash available. So your job as the person who's come up with this cash budget is to make some recommendations to management. What are they going to do? They need $225 more. Well, they're either going to have to pay slowly, which means pay a little bit later than they expected, or they're going to have to somehow increase the amount of accounts receivable they can collect. Remember, we talked earlier about using some incentives for people to pay early by giving them discounts. Or as a final measure, we'll have to take out a loan in order to cover that $225 deficit that we have on our bills. So that wraps up the first part of Chapter 14, where we looked at the budgeting process in general for a company, looking at the process of budgeting, starting with the sales budget all the way down through the cash budget. And what we're going to do in the next module is take this budgeting concept and actually budget for a particular unit of production that we're going to make. For each unit, we will have a budget. So that's what we'll do in the next module.